Crypto assets are still the hottest topic in the fintech universe, maybe a bit overheated. Don't know how long that is still going to last with the emergence of generative artificial intelligence. We'll see. We have an august panel of experts who do not need introductions, so I will not do that. People can read their details online if they want to. And I'm personally very happy that at this 7th episode of the Afore FinTech Conference, I finally get to ask the questions rather than to answer them. In the previous episodes, I always do answer the questions. And I would like to start this round, this panel, really with the title of this session. Looking back at the development of the crypto ecosystem to date, with spectacular growth, but equally spectacular collapses and eye-watering losses. Is there a future in crypto, or is it, as the session title says, just a flash in the pan? And I would like to ask each of my panelists, from their different vantage point, what are their expectations, hopes, fears for the crypto ecosystem going forward, and why that is. And I would like to start with Eva from the Financial Stability Board Secretariat. And Eva, if you could focus also on what lessons regulators are learning from the developments, good and bad. So Eva, over to you.
Thank you very much, Peter, and a pleasure to be here. Well, is there a future for crypto? I'm not sure this is a question for regulators to answer, but crypto has existed for more than a decade and may very well continue to grow again in popularity and evolve and change phase despite the sort of downturn we're seeing now. If it does, I mean, recent developments have actually demonstrated that authorities have a role here and must act given the risks that actually these activities give rise to. And so we have seen what these risks are about. I mean, the recent fallouts exposed just some rather inappropriate and unsustainable business models that essentially depended on ever increasing crypto assets prices or just relied on new investors to serve the returns they promised to existing investors. So the type of maybe pyramid scheme. But then also liquidity and maturity mismatches that expose platforms and protocols to run risk, highly leveraged positions, which lead to margin calls or automatic liquidations, and a high degree of interconnectedness, so far largely within the crypto sector. And well, the fallout of FTX and other market players also highlighted a number of issues with crypto trading platforms, which combine multiple activities. I mean, we now refer to these as multifunction crypto asset intermediaries or crypto conglomerates. And normally in traditional finance, there would be a strict regulatory firewalls, but I mean, this all doesn't currently apply to these intermediaries, and um, and so, well, this iteration gives rise to vulnerabilities. We've seen lack of transparency of corporate structures, financial positions, then conflict of interests of key function holders within these intermediaries, lack of segregation, and reliance on self-issued unbacked tokens as backing, and well, interconnectedness within with affiliated entities. So I mean, we have found that spillovers outside the crypto asset ecosystem to traditional financial to the traditional financial system is still limited, which somewhat reflects the limited interconnectedness with the traditional financial system. But we also have seen that there are interlinkages that could grow actually very rapidly, and then the rapid evolution, also the international nature of these markets, raise then the potential for regulatory fragmentation, arbitrage. So from our perspective, doing nothing is not an option, and crypto assets may grow again. And if they do, regulators just need to be ready to act, and that is currently the reason why crypto asset regulation and policy figure very high on the FSB's agenda, as well as also the G7 and G20.
Okay, yes, thank you. And Val, from your perspective, you've been looking at quite a few enforcement actions already. Do you still have a lot of work ahead of you, or is this flame going to self-extinct itself and you won't have to bother anymore?
It's a great question, and I have a question back for you. When do I get the chance to ask the questions instead of being on the hot seat?
That you'll have to ask Nick.
Yes. Anyway, it's a pleasure to be here on this panel with the great panelists here. So thank you for having me. And I just have to mention that my remarks here are, of course, my own and not necessarily those of the commission or any commissioner. Yeah, as I look at what's happening in the markets today, we have pretty big concerns around investor protection and market integrity. Eva has mentioned, what we've seen in the markets recently, especially in, kind of these trading, lending, and borrowing platforms in the crypto space. As we talk about crypto, there's always that point made, I think, in the last from the last speaker as well. There's a difference between the technology and crypto. But they are interdependent because, the technology itself, the layer of DLT, the computational layer, is powered by crypto, and crypto powers the activity in the DLT space. They are interdependent because crypto itself, of course, provides an incentive to participate. So as we look at the use cases, our job as regulators is not to try to stifle the innovation or to drive it in a particular direction. We really have to look at what our mandate is. And at the SEC in the US, it's really to protect investors in the markets. And so when these crypto assets are being offered and sold to raise money for a project, and people are being promised profits through the purchase of these crypto assets and through the efforts of the promoters of these projects, then that is the hallmark of a security in the US. And so we're gonna regulate it. I think what I'm seeing in the markets today, and I've been studying them since 2012, is we've had the unraveling of Terra Luna, we've had the recent collapse of FTX, we've seen the fallout effects from both events. We're seeing customer losses, suspension of customer redemptions, bankruptcies. These are familiar problems in the financial world, and they are caused by a number of factors, including non-compliance with important legal frameworks, lack of internal governance and control structures, hidden interconnectedness, lack of data. This leads to concentrations and fragilities, a buildup of leverage, just a lack of basic protections that would cover things like disclosure to investors, fair trading, anti-fraud, anti-manipulation, anti-money laundering, countering the financing of terrorism, and those kinds of things. And so at the SEC, we do see it as our job to bring more investor protection and market integrity to these markets. Our chair and Gary Gensler and the chair before him, Jay Clayton, have been pretty clear in reiterating that our longstanding position has been, we don't look at the label of something, we look beyond it and see what the economic reality is of any particular transaction. A lot of these things, as I mentioned, are being offered and sold as securities in the US. And so these platforms that are operating in non-compliance, they will have a choice. They'll have a choice to continue to operate in non-compliance or to come in and talk to us and register with us. And I hope that they take that second path. So the chair has publicly asked the firms to come in, get their crypto assets registered, regulated as securities. And for crypto asset intermediaries, whether they call themselves an exchange or broker dealer, or they're offering, vertically integrated suite of products and services, they need to come into compliance if they're going to continue to trade securities. And I think the recent market events just show why it's critical that these platforms come into compliance. The chair's also discussed issues relating to stablecoins. Stablecoins are embedded in digital trading and lending and platforms, and the use on these platforms may facilitate those who are seeking to sidestep regulation. And so to the extent they are involving in securities, the SEC is going to continue to apply full investor protections. And in terms of the vertical integration, I think there's going to be a lot of work looking at whether or not the conflicts of interest created by such structures need to be resolved and mitigated, and whether that means that certain functions need to be disaggregated or separately registered. So those are things that the chair has asked us to really study, and I know that that kind of work is going on with the international standard setting bodies as well as the FSB. So to focus on your question, which is my expectation, hope, and fear, I think my expectation is that there's going to be a coalescence through global work, that there needs to be investor and market protections in this space, and either through the application of existing law or through the implementation of new law, depending on the jurisdiction, that is going to occur. My hope is that firms will work with regulators globally in order to meet the expectations that will be placed by the global regulators on these firms. My fear, I guess, is that they won't do this. They'll continue to operate the way they're operating, and I don't think, in that respect, we're going to see the promises of DLT, because anything beneficial is going to be drowned out by the harm that will continue to happen as firms do not comply with basic investor and market protection and other frameworks like AML and CFT. So with that, I'll just wrap up by making the point that I think that the technology is still relatively nascent. It is ever evolving, it's fast evolving. One thing it has done is to make us return to our core principles and take a hard look at how we regulate, why we regulate, and it does challenge us to do better. And so that's what I think we'll see in the next short time frame.
Okay, thank you. Both Yuval and Eva, you paint kind of a picture, bit sobering about the risks and the problems, but definitely suggesting that crypto is not going to self-incinerate and that crypto is going to be with us for the future. But maybe I should ask people from the industry who are running or driving this market and development, how they see it. So moving over to Katie, we're very much into ladies first in this panel. So Katie, what are your hopes, expectations, fears, aspirations, whatever term you want to express for the crypto world?
Hello, Peter, and delighted to be here. I should say that in spite of all the market turbulence, particularly in the last year, I am absolutely unwavering in my belief that the potential of crypto remains. I think many panelists have already said that the blockchain technology has transformative potential across many industries. So whether that's improvements to traditional capital markets with faster clearing and settlement, or real-time tracking of goods as part of supply chain management, I think the potential use cases really are endless. And I think there's an important point here, and one that Valerie rightly picked up on, is that we often hear the narrative that blockchain technology is good and that tokens are bad, but the two are very much inherently linked. And there are plenty of projects that are showing the blockchain's real world potential, relying on tokens in order to function and grow. And we are seeing these use cases emerge. So just one example, Filecoin, it's a great example. distributed cloud storage network. It uses tokens to incentivize participants to act as storage providers. And then, of course, there's Web3, which many panels have touched on. Today's internet largely run by a handful of centralized companies that got access and then monetize their users' personal data. Web3 is going to be owned by the builders and users and are going to be orchestrated by tokens. So it's going to create a much more decentralized, community-governed version of the internet. So for example, in social media, tokens are going to change governance. With tokens, users can vote on future policies, they can store content. And then in streaming, tokens can allow any creator, not just the major labels or studios, to issue, track, and earn from their content. So I really believe that crypto assets have the potential to transform the economy and society. And I think we're at a really early stage of development. The innovation that's going on is truly revolutionary. We can't even imagine right now all the use cases. And I think there's a really great opportunity for Europe to capitalize on this next wave of technological innovation. And the rewards really are there for the taking, and Europe should absolutely seize them. I should, of course, say that there's no denying that the recent market events have been brutal for the entire crypto asset industry. We've got a combination of a bear market for crypto and then a broader macroeconomic downturn. And then the FTX failure was a black eye for the whole of the sector. But the failures that we've seen in the market haven't had anything to do with the technology itself, which has actually proven to be very resilient. And at the same time, we're seeing extraordinarily strong interest from institutional players who want to participate in the market. So for us at Coinbase, we think it's a good time to put our heads down, to innovate and to build.
Okay. Well, thank you very much for this very uplifting story. So moving to Mike, are you even more bullish about crypto in the future, or I won't prejudge what you're going to say. You choose yourself.
Sure thing, Peter, and I'm glad to be with you and with the rest of the panelists here. Look, at BNY Mellon, we really take an expansive view of digital assets. So crypto is an important part of it. There is, digital cash in various forms, and then tokenized assets, right? Like tokenized financial instruments as well. And it's really, to Katie's point, it really is early days, but it's absolutely important to recognize there's a real powerful innovation and actually just being able to actually transfer digital value, right? Or transfer value in a digital form. And what that unlocks, or the possibilities are really endless, right? So I think we should not lose sight of that, because of with the market gyration, the transformative power of this space. Just to for context, at BNY Mellon, we serve mainly institutional clients. We touch more than 20% of the world's investable assets. 97 of the top 100 banks are our clients. 93 of the top 100 asset managers in the world are our clients. So we have a very diverse client base and a unique vantage point. And what we see is clients are absolutely interested in digital assets broadly, right? Not just crypto, but all the different forms that I mentioned. We recently conducted a study, late last year, and one of the key, the stats from that is actually more than 90% of them are expecting to invest in, in tokenized assets in the near future. So, given this backdrop, this is here to stay for sure. It's important that we navigate this space, in a responsible way, right? So we absolutely need, clear regulation and rules for the road. We need responsible actors, who can offer reliable services that lives up to investors' trust, and the investor protection, that Val was talking about is, super important. And we actually see that being a gating factor, for this space actually, to take off. And again, as Katie said, there's no denying the failings that we've seen in the past year are a setback for the sector, right? Absolutely. But it also shines a bright light on things that we've known, but that really need to pay attention to, whether it is in investor protection, proper risk management, trusted services that we talked about, client asset segregation, client asset safety, the bankruptcy remote type of constructs, how do you maintain trust in the market integrity, right? Like, and so these are all important things that we need to tackle, and absolutely not lose sight of the promising potential of this, this space as well.
Thank you. And finally, Fabian, you at Moody's are experts in looking at all kinds of assets from a risk point of view, and letting your methodology and expertise shine light on whether these assets are worth something or what the risk of them is. So how do you at Moody's see this crypto market, and what hopes do you have for it? Is it a flash in the pan, or does it have a future, a promising future, or whatever future?
All right, thanks, Peter. Very glad to be with all of you here today. So first thing is, I believe that at a minimum, the technology is here to stay, and finance will likely be powered more and more by blockchain-like technologies. But let me zoom out for a second and go over what I like to call the 3 buckets of digital finance, and that's really what we use at Moody's to look at the different components of the digitalized markets that we're observing. So first bucket is digital infrastructure, or as I like to call it, modern backend financial plumbing. And it's all the usual assets and transactions that we are used to in traditional finance, but made more efficient and potentially cheaper by blockchain-like technologies. And in this bucket, you have digital securities and asset tokens, a bunch of other things. The second bucket is native digital assets. So that's all the new assets and the new structures that only exist thanks to new technologies like blockchain. And in that, you have unbacked cryptocurrencies, NFTs, stablecoins, CBDCs, and DeFi protocols. And the third bucket is what we call digital exposure. And it's really all the existing structures and entities that are exposed to new risks and the new digital assets in my second bucket. So that's banks and asset managers and exchanges, and also a bunch of non-financial organizations out there that are more and more exposed to digital assets. So the first bucket, digital financial, the digital infrastructure bucket, is likely going to be the biggest, simply because it's all about efficiency with blockchain and DLT that have the potential to generate cost savings, to generate time savings, in particular in processes that involve and include multiple parties and multiple handover steps, thinking about trade finance, for instance. And also we've seen many examples of successful digital bond issuances in recent years, and we expect to see more. DLT can also significantly help modernize payment systems. And you have heard announcements by organizations like Visa and SWIFT. And on that global payment side, there is also all the work done on stable coins and central bank digital currencies, and the asset tokenization market, which we heard about in the previous sessions, will also likely grow significantly. So again, just a reminder, asset tokenization is essentially the process of transforming real assets and the legal rights that come with them into digital tokens or digital stamps, if you want, that can be represented, stored, exchanged, traded, and tracked on the blockchain. And the asset could be anything from a financial security to real estate or a piece of art. And all those digitalized or tokenized assets in what I called bucket 1 earlier can have several benefits, and I'll mention just 4 of them. Increased liquidity of assets that are typically illiquid, and the subsequent creation of a secondary market can also facilitate additional liquidity. Fractional ownership, so that both borrowers and investors can access financing opportunities that they would not otherwise have access to. Transparency and data integrity, and that's really about reduction of human error, built-in immutability features, and audit trail functionalities, and of course faster settlement with, for instance, ownership rights that can be transferred almost instantaneously. And essentially, in all that digital infrastructure work, there are digital assets and digital tokens, to echo something you had said before, but not necessarily cryptocurrencies.
Okay, thank you very much for these perspectives. Now, this being a policy conference, do you think that the expectations and the hopes and the fears that you've expressed should be framed or supported or countered by policy and regulation and its enforcement, or should we let nature take its course in determining the future of finance, either to blow itself up or to form the foundation for what is currently still, in my personal perspective, a much hyped Web3 environment, but it's not because it's currently maybe much hyped or overhyped that it won't become a reality. So maybe we'll start with Fabian first. Sort of, do you think that policy and regulation are needed, are helpful, should be avoided? What's your view on this?
What we've heard for a while now from many market participants is that they were waiting for regulatory clarity to get into the field. People were essentially saying, I'd rather have rules that I'm not a huge fan on rather than no rules at all, because I don't want to kick off a product or an activity that could become illegal or, I don't know, not tax efficient 2 years down the road. So focusing on crypto finance for a minute, it may get a second wind if all the regulatory frameworks that have been and are being developed restore confidence in the system. So now that you all know that I like buckets and definitions, let me again clarify the point here. When I say crypto finance, I really mean the subset of digital finance that involves cryptocurrencies. And of course, as Val and Katie said earlier, there are digital assets outside of pure crypto finance. And I've just mentioned asset tokens. So financial institutions and banks in particular have always been very cautious with respect to cryptocurrencies. And one of the reasons was the lack of rules and regulations around crypto. And that cautious approach is one of the reasons why, as Eva said earlier, there's been very little contagion from crypto finance into the traditional financial system. And in fact, regulators are pushing banks to remain cautious, and we have already commented on the fact that vigilance on crypto asset risks is credit positive for banks. But what's interesting is that a lot of the events that we saw last year and that are really continuing into this year were actually commonplace before traditional financial markets were more or became more regulated. And we've seen really the usual pattern of loss of confidence, followed by bank run-like scenarios, followed by a liquidity crunch, ending in either bankruptcy or bailout. But what seems to be very specific to crypto is that it's very sensitive to any types of announcements, news, rumors. And in fact, to date, crypto finance has been relatively opaque with uneven reporting requirements. So if market participants can really see the real relevant data to make informed decisions because of the lack of transparency, panic effects are a lot more common. And all the policy and regulatory work that we are seeing, in particular around transparency and governance, could certainly help restore some form of confidence. And what I expect is that when all the regulatory frameworks out there are finally in place, institutional investors will be able to step in and participate in the crypto environment, especially low volatility crypto assets, which, as I said earlier, may actually give crypto finance a second wind.
Thank you. And Katie, so you said, look, you were very bullish about this future of Web3 and the role that tokenization and blockchain play in there. Is policy necessary, helpful, or regulation necessary, helpful for that? Or if policymakers start touching it, does that mean the end of the Web3 environment before it even started?
No, absolutely. I'd say that right from the beginning, Coinbase has sought to be the most responsible, trusted, secure, and global compliant global platform. So we very much welcome regulation. I'd say it's actually existential for us. I think it's inevitable that centralized actors will be regulated, and we want that regulatory and legal clarity. We think that's so crucial for raising standards across the whole industry and really driving the development of a legitimate and trusted industry of CASPs. But I think it's also important that we take a different approach for the more nascent parts of the market. So, for example, like DeFi, which is not systemic and has huge potential. And I think Europe has really taken the right approach to this. So leaving DeFi out of the scope of MiCA and taking time to explore it. And likewise, the UK, it's put DeFi on the table for exploration, but isn't prescribing a regulatory approach. So I think that's one area where it's a kind of like a wait and see, explore it in more detail. And I think there's another area where it's important not to stifle all the innovation that's happening before it comes to fruition. And it's a topic that Farah touched on the previous fireside chat. And that's around self-hosted wallets, which I also prefer to call personal wallets, which are the gateway to Web3, and they're going to be the mechanism by which individuals have true control and ownership over their crypto assets, over their keys, and over their digital identities. So we saw attacks on self-hosted wallets in the context of TFR that might be re-litigated in the context of the AMLR. But for me, personal wallets are critical to delivering on the promise of Web3. And it's important that all the development and innovation that's taking place around personal wallets isn't pushed offshore.
Okay, thank you. And Mike, you work already for a highly regulated institution, and I think it would not be an exaggeration to say that your regulators aren't necessarily too pro-crypto or too pro-blockchain. But do you think that you, as a major bank, a major financial institution, can play the role or can play a role in the future of crypto, either with the existing regulation? Do you need the rules to be adapted? Should the banking regulators ease up a bit to let you engage in this space? What's your view on this?
Sure thing, Peter. We actually, to your point, I mean, not surprisingly, we have very constructive engagements actually with our regulators on this topic, and we work closely with them across several dimensions. And having that policy and regulatory clarity is really essential. It's important that we have a level playing field. As one mentioned earlier, some of the reason why you don't have some of the large institutions actually in the space is waiting for that clarity, and having clear regulations that really enables competition and actually draws in institutions with the experience and rigor to enter this space will, it's our view that it would ultimately benefit the end consumer and investors. So that is important. So whether it is, alignment on the taxonomy, the definition of these different assets, what type of treatment is required, and harmonization across jurisdictions to the extent possible, right? So you don't really run into this regulatory arbitrage is really essential. And then there are core principles that we need to really, make sure we pay attention to. For instance, technology neutrality, right? If the underlying activity and risk is the same, we should be consistent, right? Of course, we need to examine the unique risks, the technology that introduces, and we need to address them. But we really need to look through the activities and make sure we tackle it that way. Another part I would mention is also watching out for unintended consequences. For instance, to Val's point earlier, I think for investor protection, disclosure, transparency is essential, right? So we absolutely see the value in that. But if you're doing that, let's say by adding client assets to balance sheet, there are other consequences, capital requirements actually that are extremely prohibitive for an institution like ours actually to provide these services. So while we are supportive actually of the intent in terms of what we want to and how we want to help the end investors, we don't want to be in a situation where it's going to keep actually actors like us outside of this and really keeping these activities outside of the regulatory perimeter. So but it's something that we're hopeful, actually, working with our regulators and the clear understanding. These are the things that we can iron out in the future. But that's really essential that we have these things in place for responsible innovation that we all want.
Okay, thank you. And Val and Eva, I know that the SEC and the FSB are not in the business of industrial policy. Your primary objectives are at the FSB financial stability, at the SEC it's investor protection, market integrity, but also, I think, if I'm not mistaken, capital formation. And does the crypto market present opportunities in the area of maybe capital formation that need to be enabled, or what space is there for regulation? Well, I think you already said regulation is necessary, but what kind of regulation? Regulation to control things, to calm things down, or also regulation to support and to enable activity? Or is that not really the way you look at it? Val, maybe you first.
Sure, and where I sit in the SEC is in the Strategic Hub for Innovation and Financial Technology, and so the mission of my office is really to encourage beneficial technologies that would help the markets, help with capital formation, but also not at the expense of the investor or market integrity. So that's always the balance that I have to try to encourage. I want to push back on a couple things that I think just need a little clarification. I often hear that crypto is unregulated. That's just not true. I think crypto is often treated as its own asset class that it sits aside from everything else. But I think it's helpful to remember that DLT and blockchain it's a new way to issue and transfer value, but the tokens that are being transferred, they represent something, and they can represent a security, a commodity, a derivative, something else, identity, attributes. And so we're going to look at the activity and what's being carried out in any particular system or product or arrangement, and we're going to apply the same rules that apply to that function or activity that we apply in the DLT space. And so I would say, it would be helpful to stop thinking about crypto as its own asset class. It's just a way of representing an asset, and that asset is something that we are familiar with. And in the case of a security, the securities laws apply for commodity derivatives. That might be our sibling agency, the CFTC. So just pushing back a little on that concept. And I think the other thing is this concept of neutrality. So we don't want to pick and choose technology, and we're pretty much technology agnostic. We're going to focus on, again, the function and the activity. And so when you talk about a level playing field, I think you're talking, we want to apply the same rules and regulations regardless of the technology used. So we're going to try to apply that level playing field across the same activity. It could be performed by different types of entities, but that's the kind of the concept. And then thinking about DeFi, I think we helped write a report through the IOSCO. It came out in March 2022, and I think what we discovered is that a lot of what's happening in DeFi is not really that decentralized. I think there are efforts to look at innovations around governance, and so you've got certain structures being developed, like DAOs or governance tokens. But if you really look behind what's happening, you have a lot of very centralized activity, and it could be dressed up with different labels, but a lot of what's happening there is happening off chain or supported by other types of platforms that we're all familiar with, social media and the like. And so again, with DeFi, there are risks, there are challenges, but we're going to try to take a technology neutral approach there too. So I guess I would just end by saying, I would challenge the innovators out there to get innovative around compliant technologies. Like, there are a lot of really interesting solutions that I've heard about how, this technology can be harnessed in a way that ensures protections and also privacy. And so, we're not there yet. I think there's a way to go, but I want to encourage those innovators and entrepreneurs that really want to develop that kind of technology, because I think that will have the staying power, and that, it may take longer to develop, it may be a longer road, but in the end, it's going to be those technologies that I think will stand the test of time.
Okay, thank you. And Eva, do you think that crypto has a stability dividend? So there's a lot of look at the stability risks, but is there a resilience or a stability dividend, an opportunity, a resilience opportunity in blockchain and crypto, or that the FSB may take a particular interest in, or what's your expectation there?
Well, maybe, and since I'm positive and optimistic, I certainly hope so. The FSB has always made clear that its objective is to harness the benefits of innovation while containing the risks, and the mantra and underlying principle of the recommendations that had been issued for consultation October last year. As you know, there is one set on crypto asset activities generally or broadly, and then a specific set on stablecoin arrangements. Essentially, these are proposed amendments to recommendations that had been issued already in 2020. And underlying these sets of recommendations is the principle: same activity, same risk rules. We want to be technology neutral. And very much focused on outcomes. That's why the FSB is having a role of coordinating the international work on regulation of crypto asset activities with the national authorities and the international standard setter bodies. So there is somewhat a subsidiarity principle that, it's the sectoral regulators or standard setters that set out how to apply the existing standards to crypto asset activities, and the FSB has a role in making sure that nothing falls in between the chairs, so to speak, and to ensure that all these activities are consistent and complementary. So the focus clearly, as you say, is on financial stability, and so our recommendations don't cover in depth sort of the investor protection, data privacy, AML, CFT, competition policy, taxation, and then also the monetary policy, monetary sovereignty aspects of the. But we are trying to bring it all together in a manner that ensures that there is a consistent framework within which then market participants can operate with some also certainty and predictability, also ensuring that there is no fragmentation or arbitrage opportunities, and so much with a view to harness the benefits and allow innovation to progress and flourish.
Okay, thank you. Now, Nick gave me the moderator spot for this session, which as I said, I'm happy about, but I'm also going to abuse this for a bit of a self-centered question. As all of you know, and most people in the audience know, I had some input in the design of MiCA and its negotiation through the Parliament and the Council of Ministers. And so I would like to ask all of you, have we done a good job? Now, you can be critical if you think that we've done a lousy job, say so. I've got very thick skin. Of course, if you want to throw flowers at it, that's also, I'm much more like that. But so have we done a good job, and are we done? So is this enough, or should we do more? Should we do something else? And if so, what should we be doing? And maybe we'll start with Katie this time. So MiCA, job well done.
So I think it's important to remember that in MiCA, Europe has reached agreement on the most comprehensive regulatory framework for crypto assets globally. And I think it's important to recognize that this is a landmark moment in terms of providing legal and regulatory certainty to the market so that firms like Coinbase have the confidence to invest and grow in Europe. And we hope it will incentivize other firms to onshore in Europe too. With regards to the requirements themselves, we think that the EU landed in a broadly sensible place for the requirements for cash. You'll be pleased to hear, Peter. So just to give a few examples, the licensing regime will signal to consumers which CASPs meet minimum standards. The risk management and governance rules draw on well-established practices from traditional finance. The prudential requirements, they're proportionate. They don't try and replicate the rules for large diversified banking organizations. And there's a very proportionate approach to asset listing that focuses on supervision of firms' processes for assessing and reviewing tokens. We do think the requirements maybe went too far in terms of the extent of liability put on CASPs, in terms of the liability for the information that has to be included in white papers, and also the burden of proof relating to custodial liability. But I think all in all, overall, we think there are pretty sensible rules for CASPs. But I do think it's clear that the EU will be a much more challenging regulatory environment for stablecoin issuers. I think one of the key challenges will be complying with the cap on issuance for non-euro denominated stablecoins in terms of which transactions are in scope to implement the issuance cap and what happens when that cap is breached. I'd also say that MiCA is very challenging for euro-denominated stablecoins because of the capital requirements, which don't take into account the fact they're backed by highly liquid assets and also the ban on interest. And I think for me on that, there's like a broader strategic point here, which is that stablecoins are the entry point into DeFi. And so for me, the EU should be trying to promote the development, at least of euro stablecoins, to position itself as a leading currency for DeFi. I should also say that I think stablecoins can and should coexist with and complement a euro CBDC. And so I think stablecoins can drive real innovation and competition in the payment space for Europe. And I think that's potentially one area where MiCA went a little bit too far.
Okay, well, thank you. Very clear. Fabian, what's your view on it? Is MiCA a job well done? Is there something missing? Should we do something more? Should we retire?
Very comprehensive, as Katie said, but as you alluded to earlier, Peter, and a bunch of us really on the panel, Katie did as well, DeFi is nowhere to be seen in, actually not just in MiCA, in the regulatory frameworks that I'm familiar with. And the only exception might be the new requirements on smart contracts in the EU Data Act, but that's not even specific to DeFi. It's also for centralized finance. So notably, DeFi not anywhere, and there might be several reasons for that. One of them being that some argue that pure DeFi doesn't exist. And actually, Val touched on a very important point earlier. If you look at activities rather than entities, the roles may already be available out there. But even for people that do believe that DeFi exists and is very unique within crypto finance, we're talking about a very small market here, roughly $50 billion, or actually even less than that currently. So there's no real sense of urgency, despite some calls out there to regulate DeFi. So the market is small, and even the protocols that performed as planned during the crypto finance crisis, they're all under pressure as soon as cryptocurrency prices and trading volumes are low. So following last year's events, there's been interesting discussions on the very principles of DeFi, including the fact that DeFi protocols don't rely on just one or a couple of entities that could collapse or inappropriately takes excessive risks. And I'm thinking about very high leverage, for instance, or misuse of consumer funds. We talked about both of these points earlier. But at the end of the day, the rules of DeFi are designed to be pre-agreed to and somewhat set in stone, and also fully transparent. So now, because of those core principles, DeFi could grow beyond just cryptocurrency trading and crypto lending if more digital tokens are available in the economy. And that includes all the assets in what I called bucket one earlier, digital securities and asset tokens. And it's likely to happen, and in particular with legislations like the DLT pilot regime in the EU that's kicking in a few weeks, and other similar initiatives in other parts of the world. And when this reaches a critical mass, there might be more incentive to design regulatory frameworks for DeFi, and they may look very different from the existing ones. For instance, regulations may be directly embedded in the code of DeFi protocols, but we're likely many years away from that if it ever happens.
Okay, thank you. Thank you. Now, Val, I'm not going to put you on the spot to opine on MiCA, although if you want to, you may, of course. But maybe can you reflect a bit on the US situation, and also in particular on your own agency? So we've noticed, we've heard that the SEC has focused on enforcement of existing rules. You said MiCA is crypto is not unregulated; the existing rules apply. You have, I think, 100 enforcement cases so far, which is quite a track record. But at the same time, we continue to see confusion, spectacular failures, collapses, potential frauds. And also in Brussels, of course, we hear the echoes of the calls for congressional action, or the criticism even of the SEC that it is regulating by enforcement, and that this is improper, that it should regulate by regulation, either by promulgating rules, new rules, or by calling Congress to act. What's your view on this?
Yeah, no, thanks for the chance to go over some of the key events that have been happening in the past year in the US. So last year, the Biden administration issued an executive order on ensuring responsible development of digital assets towards a whole of government approach to addressing the risks and harnessing the potential benefits of digital assets. This led to the departments and agencies in the US government working together on a number of reports. A number of them came out, probably close to a dozen, relating to all aspects such as consumers, businesses, investors, illicit finance, cross-border cooperation, law enforcement, financial stability risks, kind of runs the gamut. And in particular, the Financial Stability Oversight Council, which is the FSOC, issued a report on digital assets, financial stability risks and regulation. It found that crypto asset activities could pose risk to the stability of the US financial system if their interconnections with traditional finance increased, or if their overall scale were to grow without adherence to being compliant with existing inappropriate regulation. The FSOC report recommended that FSOC members continue enforcing the existing rules and regulation. It noted that a large part of the crypto asset ecosystem are covered by existing regulatory structure. It recommended some passage of legislation and rulemaking steps to address regulatory gaps identified in the report, more specifically the spot market for crypto assets that are not securities, and had other additional recommendations around stablecoins, vertical integration, and governance. And it recommended that the coordinated, kind of US government engage in monitoring, supervision, and regulation of the crypto asset activities. So, I'm sorry, I'm hearing somebody's echo. So just from the SEC side, we have issued some recent guidance, and I'll go over that. We issued in December 2022 from the Division of Corporation Finance guidance to public companies on the disclosure obligations under the federal securities laws relating to crypto asset activities. So just a bit of a list of things that companies should consider when they're thinking about how they should disclose their activities relating to crypto assets. Our same Division of Corporation Finance, and this is the division that reviews public filings, they added an Office of Crypto Assets to their division's review team. And so this office will, leverage the expertise that they've been building over years and increase the resources devoted to this type of review. We, along with the CFTC, the SEC proposed a joint rulemaking on Form PF, which is the confidential reporting form for registered investment advisors to private funds, including those that are also registered with the CFTC. And this rulemaking went into what they have to disclose around their asset holdings, including crypto assets. And as you mentioned, the SEC does have a strong enforcement program. We don't, we don't believe we're regulating by enforcement. We just believe we're enforcing the law. And if the activity that's being conducted, regardless if it's on a blockchain or, in a brick and mortar entity located, somewhere, we are going to apply our laws. And so I think our enforcement cases run the gamut of anything that we've found is being violated kind of in the traditional space, can be and is being violated, in the crypto space. And so we're not, when I talk about level playing field, we're going to take an agnostic approach and enforce the law kind of blindly to the technology used. So some of the more recent cases we've brought, I think, really go to some of the fraud and bad activity that we've seen, and the key to, taking investor harm very seriously. We've brought cases against Sam Bankman-Fried and others for their defrauding equity investors in FTX trading. These are the allegations. That's a litigated case, so I can't go beyond that. A former Coinbase product manager for insider trading around information about listing certain assets, trading before that happens. Kim Kardashian for touting on social media crypto asset security, Ethereum Max, without disclosing the nature, source, and amount of payment. Individuals involved in TradeCoin Club, which is a fraudulent crypto Ponzi scheme that raised more than 82,000 Bitcoin worldwide. And then recently a case involving Mango Markets and an individual that manipulated the governance token, which we allege is a security. And so, we will continue to bring cases where we see misconduct, and I think that is in line with our investor protection mandate. Other agencies have also put out recent guidance. I'll just point out some banking regulators who have made recent statements regarding risks associated with crypto assets that banking organizations should keep in mind if they're assessing whether the activities can be conducted in a safe, sound manner. And also a statement clarifying that banks supervised by the Fed would be subject to the same limitations on novel banking activities. And so I point to those. I can't really speak for my banking colleagues, but those statements are out there. And so that's kind of an overview.
Okay, thank you. Now, in an effort to almost end on time and not to let the US Treasury wait, as Nick said, Eva, I know you're not in the business of giving marks to FSB jurisdictions, but if you could give marks, how would the EU score? Would we pass muster, or would the FSB sort of say, well, you haven't really acted on our recommendations?
Well, I should have just like Val did, added my disclaimer and say that whatever I say is not necessarily the view of the FSB or its members. And indeed, I mean, we well, I won't be able to give marks, but I mean the role of the FSB is to promote consistency as amongst national regulatory frameworks, and so, I mean, we that's the purpose of developing these high-level standards and recommendations. And I think your framework looks at first sight pretty consistent with what we issued, and it is flexible so as to allow different approaches at national levels for implementation, and the FSB provides a forum to facilitate exchange, information sharing, of regulatory approaches, so as with a view to ensure that national approaches are consistent, and that's critical because crypto assets are inherently global, and here our role is then not only to promote implementation amongst our members, and I mean, the European Commission has been participating actually in the development of the recommendations, but also beyond membership. And as you know, this is critical, as many of the activities we've been talking on were actually operated and conducted out of jurisdictions that are not FSB or and G20 members.
Okay, thank you. Well, I'll use my position here to give ourselves a mark. I think we score a B minus, sorry, a B plus or an A minus on a good day with MiCA compared to the regulations. I see Nick has come online, so I'll hand it over to Nick in just 1 minute, but I don't want to deprive Mike of the opportunity to, for 1 minute, to say whether or not we've done or we're doing a good job in the EU on MiCA and the DLT pilot program. If you think it's a lousy job, do say so. Otherwise, give us praise, I mean, it's short.
It's been covered well, so I'm not going to repeat it. But no, it's a very constructive, it's in the right direction. It's not done, to your point. I mean, there's a lot to build on, including areas that are actually subject to interpretation to really just make sure, like, I mean, those are clarified, but it's definitely constructive in the right. And the pilot regime also just gives the opportunity to really build a muscle and really see what works to set the rules down the road. So very encouraged by it.
Okay, well, thank you very much, and thank you to all of my panelists for answering the questions, and thanks to Nick for giving me the opportunity to ask these questions. I'll now pass it back to Nick so that he can move on to US Treasury almost on time. And I think that his German background will be very pleased with this.
Yes, you've restored part of my national pride again. Thanks so much, Peter, for doing this and being so succinct and having an excellent panel. Val, yes, you're more than welcome to moderate next time. I think you've been at our conference sufficiently often to do so. And you also are welcome to check with everybody else how good a job the SEC is doing if you want to. That is a privilege that's left to Peter alone. And you can decide whether that's a B plus, B minus, or whatever yourself. But it was a really, really interesting panel. And yes, as you say, Peter, we left the best to nearly last, at least on the substance matter, the whole issue around cryptos. And obviously we had to leave it to last because the European Parliament hasn't agreed, and MiCA hasn't been published yet. So we wanted to kind of stay within the democratic process. So I think we've done a good job. You've done a good job. Thank you so much.